For more on the AI trade in the markets overall, let's bring in Ohsung Kwon. He is the new-ish chief equity strategist at Wells Fargo, and he is out with his first ever earnings preview note in that role and is kind enough to come on Fast Money. Are you sure this is where you want to start?
I mean, that's congratulations.
Thank you. On the new rule. So I guess the debate, this bubble or not, whatever's happening, your models, you run through all these thousands of models all the time. Your models show that earnings may actually be better than many think. Why?
Yeah, so we're forecasting about a 4% beat for the upcoming earnings season. So we came up with a pretty interesting model. We essentially looked through all the macro variables that we could find, about 350 macro variables. And we went through this machine learning process to figure out where the sales could be. And it's still pointing to a pretty decent beat. So we're forecasting about a 4% beat led by AI, semis. So
is it a big enough and broad enough beat to justify the rally that we've been seeing the last few months?
I think so. I mean, people say the bar is a little too high this time because EPS didn't get cut into earnings as it usually does. But if you look at where consensus number is for Q3, it's down about 4% since the Liberation Day. Our view is that tariffs didn't really have much impact in Q3. I think it's more of a Q4 event and into Q1 because companies carry about 65 days of inventory at the end of Q2, which means that since August 7th, their pre-tariff inventories are going to run out in the middle of October to November. That's not Q3. That's really Q4. So I don't think we have yet to see the real impact of tariffs yet. And if that's the case, I think earnings are going to come in around the Liberation Day.
Okay, so earnings, good, and congratulations. So earnings are going to do better than expected, but it's still a multiple expansion to a large degree. So my question is, what is the right multiple in this environment? Because we're probably close to 23 times next year's numbers right here.
Yeah, I think it's hard to argue that multiples are going to expand further from here. I think it's really going to be more of an earnings growth story going forward. We're forecasting 11% growth for this year and next, followed by another strong 12% growth in 2027. So about low teens returns for the S&P without any multiple growth.
So can I ask a question?
You're in.
Yeah. All right.
Sure. Get in there, Karen.
So in your models, do you include what do you have for rate cuts?
Yeah, so we're forecasting about 2 more cuts this year and 2 more next year, so about 4, which is basically in line with what the market is pricing in. We actually, for the S&P overall, we came up with a pretty interesting framework called the PRISM, PRSM, profits, rates, sentiment, and macro. So those are the 4 drivers of the equity market that we have identified. If you go through each one, profits still in an up cycle. Rates is getting better because we're in an easing cycle. Sentiment is still neutral. Macro is actually improving too. So for macro, we're using growth minus inflation, which is actually still negative, but getting better. So if you combine all those 4, we're still talking about a pretty healthy backdrop for equities overall. So hence our target of 7,200 by year end next year.
Does the Federal Reserve matter as much as the AI trade? Or is this market perfectly priced to a combination of both of these things? I think to Karen's point.
Yeah.
Just worried if one of these doesn't go as planned.
Yeah, I think AI matters more than the Fed. For broadening, I think the Fed matters. Outside of that, I think it's really more about growth. There was a lot of optimism heading into the FOMC that the Fed might be easing into a reacceleration cycle. That's when we saw really the easing cycle trade happening, whether it be the Russell 2 or the home builders. Now that we are in an easing cycle, officially, we're essentially selling the news and rotating back into AI. I think outside of AI, I'm not really excited about anything. For broadening, for sustained broadening, I think the PMI, the manufacturing PMI, has to go above 50. And I don't really see that happening unless rates fall more from here, because this has been the most rate-sensitive manufacturing cycle in history. And I think the reason why that happened is because it was a housing-led downturn in manufacturing. There is some view that the non-res side is getting better, which is obviously is positive for the PMI cycle. The thing is, historically, non-res didn't really have an impact on non-res. And over the past 3 years, during the downturn of the PMI and manufacturing, non-res has been healthy. So even if non-res gets better from here, I think housing ultimately has to get better. And for housing to get better, rates have to come down. And for rates to come down, we need slower growth. So I think that actually will be negative for